Today we are going to look at one of the most famous bullish chart patterns in technical analysis, the cup and handle pattern. This pattern often appears when an asset is preparing for a breakout after a period of recovery and consolidation. In this lesson, we will explore what the cup and handle pattern is, the different types of cup and handle patterns, the imperfect cup and handle pattern, the retest of neckline entry, the inverse cup and handle pattern, and the breakout of the multi-decades cup and handle pattern in silver. Let's begin. This is the cup and handle pattern. It has a rounded bottom that looks like the shape of a teacup. After the cup forms, the price usually experiences a small pullback or consolidation, which creates the handle. The handle can take different shapes. It may appear as a small U shape, a wedge, a triangle, or sometimes just a sideways consolidation. This level here is called the neckline, which represents the resistance level of the pattern. When the price breaks above the neckline, it often triggers a strong and sometimes violent breakout as buyers step in and momentum traders enter the market. The longer the cup takes to form, the more powerful the potential breakout can be. This is silver on the weekly time frame. Here we can see a cup and handle pattern forming. This rounded structure here forms the cup, and this section here forms the handle, which in this case looks like a wedge pattern. The handle does not have to look exactly the same every time. It can take the form of different consolidation patterns, such as a wedge, a triangle, a small channel, or simply sideways consolidation. These two reversal points here form what we call the neckline, which acts as the resistance level of the pattern. When the price breaks above the neckline, the cup and handle pattern is considered complete. Traders typically enter the trade at the breakout right here, when the price moves above the neckline. Another possible entry point occurs when the price breaks above the falling wedge, which is itself a bullish pattern. This wedge often forms during the handle consolidation phase. When the price breaks above the wedge resistance, it can signal that buyers are regaining control, offering an earlier entry before the main neckline breakout. This is Bitcoin on the weekly time frame. Can you see the cup and handle pattern forming here? This time, the handle takes the form of a bull flag. A bull flag is another bullish consolidation pattern. Unlike a falling wedge, a bull flag forms within parallel channels. Traders can enter the trade in two ways. The first entry is an early entry, when the price breaks out of the bull flag. Alternatively, traders may wait for the main confirmation, which occurs when the price breaks above the neckline, completing the cup and handle pattern. After a cup and handle breakout, the market often experiences a strong and sometimes violent upward move. In reality, not all cup and handle patterns are picture perfect. If you wait for a perfect textbook pattern, you will most likely miss many trading opportunities. This is Palantir Technologies Inc. on the daily time frame. Here we can see a cup and handle pattern forming. Notice that this time, the handle forms another U shape instead of a wedge or flag. Also observe that the neckline is not perfectly flat. The two resistance points are slightly uneven. This is what we mean by an imperfect pattern. In real markets, chart patterns often appear slightly distorted, but the underlying structure and market psychology remain the same. This is gold on the weekly time frame. Again, we can see a cup and handle pattern forming here. The cup and handle pattern can appear in many different forms. Notice that in this example, the handle forms above the neckline, and then the price retests the neckline before moving higher. After the retest, the market continues its upward move and eventually goes parabolic. This type of cup and handle pattern is often considered more reliable because the retest helps confirm the breakout level before continuation. Cup and handle patterns often lead to very strong and sometimes violent breakouts, which is why many traders consider it one of the most important chart patterns to watch. This is Ethereum on the 4-hour time frame. Here we can see an inverse cup and handle pattern. which is the bearish version of the cup and handle. Instead of forming a rounded bottom, the pattern forms a rounded top, creating what looks like an upside-down cup. After the cup forms, price enters a small consolidation, forming the U-shape handle. The neckline is formed by these two support points. When the price breaks below the neckline, the inverse cup and handle pattern is confirmed, and the market often experiences a strong downward move. Traders typically enter the trade at the breakdown as bearish momentum begins to increase. The larger the cup and the longer the pattern takes to form, the more powerful the potential move after the breakout or breakdown. Now, let's look at a very extraordinary example. This is silver on the long-term chart. Here we can see what appears to be a massive cup and handle pattern that has been forming for over 46 years. The cup began forming after the major peak in the late 1970s, and over the decades, the market gradually rounded out the bottom. More recently, the price moved back toward the previous resistance, forming the right side of the cup. The current consolidation may represent the handle of this enormous pattern. If silver eventually breaks above the neckline, it could trigger one of the largest cup and handle breakouts ever seen in the precious metals market. This example shows that chart patterns can exist not only on short time frames, but also on multi-decade charts. Sometimes the biggest opportunities in the market come from patterns that take years or even decades to develop. To summarize, today we learned what a cup and handle pattern is. We also explore the different types of cup and handle patterns, including imperfect patterns, and how the neckline retest can provide a stronger confirmation before continuation. We also looked at the inverse cup and handle pattern, which is the bearish version of the setup. Finally, we examined an example in silver, where a cup and handle pattern has been forming for decades. If you found this lesson helpful, please give this video a thumbs up, subscribe to the channel, and turn on the notification bell for future lessons. I will see you in the next video.